Okay, I'm going to go over a problem where we will look at how leverage affects the return on the asset funders of a corporation. And by asset funders, I mean both the people that fund using debt and the people that fund using equity to fund the assets of a corporation. And also, we're going to look at how that affects just the stockholder or equity funder by themselves. And we're going to use this problem right here in order to do the example. Also, after I do that, I'm going to also use a form control. I'm going to put a scroll bar over here and attach it to that and see that's basically called leverage, or capital structure, how the capital structure affects the equity holder. So anyway, let's go ahead and read the problem. You're considering a stock investment in one of two firms, all debt incorporated and all equity incorporated, both of which operate in the same industry and have identical operating income of $9.5 million. So let's go ahead and put that in here. We'll say operating. Let me say given here first. So what are we given? And I'm going to make it a section, so let me bold and underline that. And we'll say operating income. And here we'll say all debt and all equity. Okay. They both have $9.5 million, so let's go ahead and put that in here. 9,500,000. Let me change it to a 9. I think that's $9.5 million. And then we can just go down here to this little drag bar and copy it across. So they both have $9.5 million in operating income. Okay, and all debt uses all debt uses $29 million. So we'll just say the debt. These guys use 29 million. And these guys, they're all equity, so they don't use any debt in order to just say if the corporation is use stock, right? And then interest on the debt is 10% in this problem. And we'll put 10% here even though they don't have any debt. And they said that's annually. Okay? And then what else we have? We have the equity. You know, these guys have $30 million in equity because they're all equity, and so it has $30 million in assets, right? And then what we're going to do eventually, I'm going to probably change this debt, or I'm going to be changing this debt. So we're going to, since we have to have $30 million between the two, if I change this, so I'm going to put an equation in here. I'm going to say this equals this minus this. Okay. So if I change this to 25, this will change to 5 automatically. And finally, the tax rate, T, it says it's 30% for both of them. Okay, so what do we want to find? We want to find A, the income available to pay the asset funder, and we'll say debt and, oh, we know both, we'll just say both. And then B, we want to know the return on the asset funder's investment. So we want to know that for both of these. What are these? Okay, so I'm going to go here to this given. I'm going to paint that format down to here. And also I'm going to paint that format to here. Because here I'm going to take solution. Okay, so what I'm going to do, I'm going to duplicate this down here. And I don't want to copy it because I want to link it, because if I change these numbers, I want them to change down here. So I'm going to say this equals this, and then I'll drag it across, and I'll drag it down, and then let's paint that as dollars. Okay, and then I'll drag it across here. And since it's all relative, whoop, I don't want to do that. Since it's relative, it's gonna. So the relative. So these are all relative. It'll pick up that, right? Okay, and then the next thing we want to put in is the debt. And we'll just say interest on debt, I'm sorry. And the interest on this debt is going to be equal to how much debt we had times how much the debt costs in a year. So 10% of 29 million is 2.9 million. If I drag that across, of course that's going to be 0, because 0 times 10% is 0. Let me put the formula in here. Now remember, just if I'm going too quick, just go ahead and pause it, right? And then you can kind of catch up. And then let's go ahead and underline this, because we're going to subtract this. And now we want to calculate the taxable income. Remember, you don't have to pay taxes on the interest you pay. So the taxable income is going to be equal to this minus this. We don't have to pay taxes on this interest. And then finally, we want to calculate our taxes. And our taxes are going to be equal to how much our taxable income is times our tax rate. Okay? And let's go ahead and underline that, because we're going to subtract it again. And then we're going to say after tax income. And we can say that equals that minus that. Okay? So, and finally, we can answer A. So I'm going to say this equals A. Well, what's the income available to both? It's going to be what the income, this is basically the income to the equity holder. This is. And this is the income that the debt holder got. So this is going to be equal to this plus this. Okay, this is it. Because this after-tax income, we already paid the debt holder up here. So this is going to go to the equity holder. If I copy that down, we have that. All right, now and then finally, we can calculate B. The return to the asset funder is both, and then now they're saying both to the debt and the equity holder, right? So this is a little bit different calculation. It's not like return on assets. The return on asset is mainly just to the equity holder, right? But anyway, what we're going to do, we're going to basically we have to divide this. So it's going to be equal to how much both the debt holders and the equity holders are getting, divided by our assets. Okay, and our assets are going to be, I'm going to go parentheses, this plus this. Oh, what I forgot to do, I forgot to close the parentheses. Okay, and we want to change it to percent, so I'm going to made it $, so I'm going to go ahead and hit the percent sign, and always take percent out 2 places. Take it out at least 2 places. We can drag that across. So let's see what's going on here now. It looks like the return is higher for the debt holders than the all equity holders, right? And probably you can see the reason, because the debt holders got a tax break, didn't they? They paid like $1 million less in taxes. So the government gave them a tax break because they didn't have to pay anything, any interest on the debt. So it made it look like they're making less money. all right? And then so they paid less taxes, all right? So that's what's happening there. So I'm going to calculate something that this problem didn't ask, okay? And I want to calculate the return to the equity funders. Okay, so I'm going to say return, let me say return on assets. Okay, so that's going to be equal to, well, it's going to be the same, it's going to be this return, right? It's not going to be both of them together. So this is the return the equity people got. Say it'd be the stockholders of the corporation. They're going to either get that in capital gains with retained earnings or dividend payments or something like that. And how much equity do they have in it? $1 million. So if I copy this format to make that percent, they're getting a 462% return versus a 22.5% return, or 22.17 return. So that's a crazy return, right? And why is that? Because they're very highly leveraged. You only have $1 million of equity for 30, and everything else is debt. So they're very highly leveraged. So this 10% would probably be higher because what bank is going to want to borrow you at 10%? You're going to be risky investments. So it's kind of unrealistic that this would be so low. This is going to go up as your cost of your capital, or the cost of any money you're going to borrow is going to go up as you get as your debt to asset ratio gets worse and worse. Okay. What we could do, we could mess around with this a little bit and just kind of see how it looks. So let's go ahead and here we're going to go to File, then we're going to go to Options, and then go to Customize Ribbon, and make sure that developer, you probably don't have this checked. You're going to check this little box here. Okay, and you're going to have a Developer tab up here. It's going to be a new tab. You probably don't have some of the other tabs. You're going to have a Developer tab. Go to that. Then we're going to go to Insert, and you're going to insert this in the second row. If you wave over, it's a scroll bar. We're going to click on that, and let's just go right over here, and we will draw a little scroll bar here. Okay, and then right below it, right here I'm going to put a number. I'm just going to type in 1,000 here, and then I'm going to go here. I'm going to say this equals this 1,000 times 30,000. That way, if I change it to 500, that's going to change to 15 million. If I change it to 100, so whatever I change this to, that's going to change. Now I'm going to have this scroll bar, I'm going to have that linked to that. So if I change that, then that's going to in turn change that. So I'm going to right-click on the scroll bar and go Format Controls. And I'm going to link this scroll bar to this number. We're going to have a maximum value of 1,000. It will change by, say, 10, okay, maybe 100. Now we'll change by 10, and go OK. And then click outside the scroll bar. Now if we move this, if we move it all the way to the right, that's up to $30 million. We move it all the way to the left. Now we can actually change this and do what-if analysis, right? We can say, well, what if the debt is around 7 million? Okay, and we can watch what happens as we move to the right or left. So you can see as we get more highly leveraged, our capital structure is more debt. What's happening to our return on assets right down here? Okay, what's happening to this as I go to the right more and more? It goes up and up and up. If I go way over here, let's not go to 0, but let's go to like, if I have $300,000 in equity and 20 million, so I'm borrowing almost all my money to finance this company. I only have $300,000 in it. Look at my return on equity. Okay, so that's why I'm saying this is unreal, because this cost to go up, because this is too risky to the debt holders. In fact, if I go all the way to the right, that's infinite. You know, if I use the penny, as I start approaching, I only have a penny of equity. I could put this like 1. I only have $10,000 in equity, right? I'm sorry, we're putting 999. Okay, so now this becomes huge, right? No, I'm sorry, 999, not 9,000. All right, so now I have $30,000 in equity. Look, I have $15,000 return. I can become a billionaire, you know, with just a little bit of, you know, or millionaire with just a little bit of. So that's very unreal. This cost would go up, or else it'd be basically impossible to borrow, right? Another thing we could do, we could create a data table and make a graph. So I'm going to go here, I'm going to go debt, and I'm going to say $0, and let's just do it by $500,000 increments. So go $500,000, 500,000. And what I'll do is I'll highlight these two, and I'll drag it down. I'll drag this down until it says 30 million. You can see there on that little right beside where you're scrolling, go to where it says 30 million. And then if we go back up to the top, I'm gonna go here, I'm gonna go equals. And that's going to equal the return to the equity funder. So I'm going to click on that. And here I'm going to go equal. We're going to use this number right here. And then when you do a data table, you have to do this exactly. You have to have this. This has to be equal to that, right? Let me put a little equals formula text. It has to do that, and then you have to have it right here, kind of kitty corner from where you start these numbers. And then, so now what I'm going to do is I'm going to highlight exactly like I have it here. You're going to start where it says debt and go over and highlight all the way down to the bottom. We'll go back up to the top again. And I'm going to go to data. And I'm going to go to Whatif Analysis data table. And the way this works, it says, okay, is your data in columns or rows? Well, we have it in the columns, so we're going to put something in here. And basically what you're going to put here is what you're varying. Well, I'm varying my debt, which happens to be this cell right here. So I'm going to click right here. And I'm going to go OK. And then all I'm going to do is, these aren't percent, so I'm going to go here, I'm going to copy this percent format. And then I'm going to copy all this so I can see it in percent. Okay? And then you can see as we go down, as we approach $30 million, it becomes infinite, right? So now let's graph this one. So I'm going to highlight here to here. And we're just going to scatter plot it because it's actually easier. So I'm going to go insert. We're going to go scatter plot with, we don't have to use lines. Let's use lines just to kind of get an idea. So we can see that, let me move it over here. So we can see that as we approach $30 million, this becomes asymptotic, right? So, you know, even anything up to 25 million, that's pretty crazy to get 100% return, right? So, it's just kind of showing you how leverage affects, though, right? But what did I say is unrealistic on this model? This cost of this debt is going to go up, or it's actually going to become impossible to borrow. Okay, so anyway, that's kind of gives you a feel for what's going on. You know, to answer the question, we should probably just highlight these two, right? Because those are the answers to the questions that it had. And this would have been 2 million, right? Or 29 million. We're going to scroll that over to 29 million. I guess 29 million would be, you have to type 966.6666 here. Also, so that makes it about 29 million. That's your answers there, right? A couple more sixes to make it more exact. Okay, so anyway, so you learned quite a bit in this video. You learned how capital structure or how debt affects a company. So what would be normal for a company? You know, who knows how leveraged they'd be? You know, maybe this might be more realistic. Maybe like have $5 million in debt or something. So you're not going to be really, you don't see companies get that highly leveraged, right? Not very often. Okay, so hopefully that kind of gives you an idea about what capital structure is all about and how leveraging a company. Most companies, there's not a lot of companies that don't have any debt, right? They're going to use a little bit of debt to try and, what's the goal of a company? They're not really in business to give money to the debt holder. The owner of the company is a stockholder, so their goal is always to make that as large as possible. So if you could, you'd have that as high as you could, right? And you give all the risks to the debt holders, but again, the debt holders aren't going to want to take the risk, so they're going to charge you more money, or not even borrow your money. They're going to be over here more, okay? Because this cost is going to go up. So hopefully that kind of makes sense. If you're doing this as extra credit, remember you need to do this on your own. I don't want you to copy another student's spreadsheet and just everybody have the same spreadsheet and send it to me. I could tell the difference, so don't do that. All right? Thank you, and hopefully that helps. Bye.